In this episode of Grist from the Mill, what you don't know about target date funds could ruin your retirement. The first target date fund was introduced in 1994. Vanguard entered the space in 2003, launching its Target Retirement Fund series, which is now one of the largest. The real turning point came in 2006 with the Pension Protection Act, which designated target date funds as a qualified default investment alternative. This allowed employers to automatically enroll workers into target date funds in their 401k plans, which dramatically accelerated adoption. Target date funds are a type of mutual fund designed to be a complete, all-in-one retirement investment. Here's how they work. The core concept is simple. You pick the fund closest to the year you plan to retire, invest in it, and the fund does everything else automatically. A 35-year-old planning to retire around 2055 would buy a Target Retirement 2055 fund, for example. The glide path is the defining feature. The fund automatically shifts its mix over time, starting stock-heavy when retirement is decades away, and gradually moving toward more bonds and fixed income as the target date approaches. The main advantages are simplicity. One fund handles everything, and no investment expertise is required. They are easy for your human resources people to explain, set it and forget it. But easy isn't always the best solution. The one-size-fits-all approach ignores individual circumstances. It ignores health, other assets, and risk tolerance. You have no control over the underlying allocation. To versus through glide paths. Some funds reach their most conservative allocation at retirement. Others continue shifting for years after. Examining Vanguard's Target Retirement 2035, we see the stock bond allocation for 2030 is 67% stocks and 33% bonds. Note that stock allocation contains 41% international stocks, which in and of itself may be a concern. This fund will follow a glide path to a lower risk allocation to equities over time, ultimately targeting an allocation comparable to the Vanguard Target Retirement Income Fund. Vanguard's stated target of 30% stocks and 70% bonds is the allocation all target retirement funds are expected to reach within 7 years after their retirement dates. That's right, you heard that correctly. The allocation shift to bolster income may take as long as 7 years. Furthermore, the current dividend yield on VTINX is a very modest 3.24%, hardly a font of income production. So, while you are waiting 7 years, investors face a larger, more consequential risk, referred to as sequence of returns risk. In a bad market year, someone near retirement can still suffer significant losses. Put simply, the timing of returns matters more than average return during retirement. Losses early, combined with withdrawals, can permanently reduce portfolio size and therefore its longevity. As the example shows, taking two $1 million portfolios with the same average return of 5% and an annual withdrawal rate of $50,000, the portfolios can differ in value by $337,000, depending upon whether the portfolio suffered losses early on in the 10-year time period measured. One of the most important debates goes to a key assumption. Target date funds assume stocks and bonds are negatively correlated, meaning when stocks fall, bonds rise. This is why shifting from stocks to bonds as retirement approaches is supposed to reduce risk. For the better part of 20 years, from the aftermath of the internet bubble through the pandemic, stock/bond correlations were consistently negative, making treasury bonds an effective portfolio hedge. That long negative correlation era, roughly 2000 to 2021, is what shaped the design philosophy of target date funds. Then the correlation flipped sharply and painfully. In 2022, the Fed instituted the fastest monetary tightening since the Volcker shock. Stocks fell by about 25%, and treasury bonds dropped about 17%. For the first time since 1958 to 1959, both fell together. This was a brutal real-world test of the target date fund assumption, and it failed badly. Retirees held balanced funds and got no protection. The picture has been shifting back but remains uncertain. Correlations between stocks and bonds stood at about plus 0.3 for the 12-month period through April 2025. The key variable is inflation. At low inflation, correlations are negative. Higher inflation typically links to lower stock and bond prices simultaneously. The most concerning scenarios involve extreme inflation, or if rates rise to compensate for higher government debt. Both are live concerns given current deficits. In plain terms, the central safety mechanism that bonds zig when stocks zag is not a law of nature. It's a feature of a specific macroeconomic regime. Investors in or near retirement who rely on target date funds may be taking more correlated risk than they realize if inflation remains elevated. Ceding control of your asset allocation to an algorithm predicated on historical data and which completely ignores your specific circumstances is dangerous. So much for set it and forget it autopilot. And that's why it's personal to me.